Thomas, great pleasure to welcome you for the wrap-up, the financials, what it all means, and stage is yours.
Yeah, thank you, Hannes, and welcome to the finance presentation. What I'm going to do is I'm going to summarize what you've heard last 24 hours, basically, from all the colleagues, and add some bits and pieces from my side as well, and then hopefully give you a comprehensive overview over the financial profile you can expect. Obviously, summarizing, I was prepared for everything what the colleagues said. I know there was no surprise except one. The last presenter, Torsten, gave me a big surprise. I wasn't aware about. The first thing he's doing when he wakes up in the morning is reading Keval's reports. I have to say, the first thing, Torsten, I do in the morning when I wake up is say, "Good morning, darling," to my wife. Think about it. Sorry, Keval. But other than this, I think it will be relatively easy to sum and round it all up, because Tim gave you yesterday already a kind of preview on what you should expect. And a lot of things of growth rates you will see of directions we're going to give is nothing else than continuing what we have started 2014 and what we have achieved so far. So we'll talk about the review 2014 to 18 and then the growth profile looking forward. And let me start with the key messages in the first instance. I think pretty simple and easy, straightforward. A is we expect leading growth in key financial metrics. And that does mean we see all of our segments growing on the EBITDA side from next year on. And that's supported by better revenue trends, but as well by a higher cost discipline. And the DTEGY US business, we guide with a CAGR of 2 to 3% for the upcoming years. So that's first of all on that message. The second part is obviously related to the first one, which is cost discipline. We will deliver our cost targets, and we'll come back to that in more detail in a minute, because obviously some of you might challenge that position as we haven't delivered the 1.8 we promised last time. So why this time? I'll come to that in a second. We're confident and bullish on that one, because there is huge tailwind we have by digitization and also by finalizing the OLP migration, which is anyway going on one hand. And on the other hand, we have used the time the last years to prepare ourselves also in terms of managing the headcount situation, especially in our German footprint, to have enough flexibility once the workload goes down, also to reduce what's needed. The third key message, I think, is on the ex-US CapEx and investments. And the first element is it will stay on a high level. You all know that, and Tim said it yesterday, we are network investors, and you can't expect profiles like this on a CapEx level from us. Will never happen. Never say never, but not as long as I am here. Oh, joke. No, it will not happen. Just want to test whether you're still awake. Will not happen, but it is a continuous investment profile, you see. But CapEx will peak this year. And I will show you more detail, in greater detail later on, what to expect. And then, which is important to us as well, on our debt policies, it remains unchanged. We had a discussion 4 years ago whether to change it, because at that time we have the expectation that we will grow, we will turn from a declining asset into a growing asset. And then the question was, shall we stay in that framework or change it? For instance, loosen the leverage comfort zone a bit or so. And we decided at that time not to do it. Now, as we have a broader operational basis for growth, we again ask ourselves, shall we change it or not? And the answer is again the same. There is no change, and what's important to us to maintain the undisputed access to the debt capital markets in the future as well. So on shareholder returns, Tim was clear on that one yesterday as well. For 2018, we will propose the 70 cent because it's still related to the existing old policy and timeline, 14 to 18. And from 19 onwards, we're going to change in the following way, that we orient ourselves and reflect much more on the growth rate on the adjusted EPS than the free cash flow. Again, I'll come back to that in a second as well. And that all assumes no deal in the US, first of all. And then obviously, number 6 is, if we get the deal approved, which we all believe will take place, because there are so many good arguments in favor for economy and the country, obviously we're going to supercharge the whole profile. So we have two versions always to think through. One is the standalone, which is a good one, and the other one is the supercharged one, which is an even better one. So that's basically where we are in terms of the key messages. Before I dig deeper into those contents here, let me use some minutes just to review what we have promised 3 years ago, actually in 2015, and what we have delivered and what not, and what the learnings from our point of view are on that one. So basically, we've given 2 pages more or less, or 3 pages. One was the finance strategy with the debt and the equity side on that, and then secondly, the key financial profile. I will run you through those. So first of all, if you look at the middle part, I think it's a no-brainer. Our, maybe not, low-risk portfolio profile hasn't changed. The reason why is quite simple. We said 3 years ago we don't going to go shopping across Europe and enhance the footprint. We're going to invest in our footprint. And so clearly the low-risk portfolio profile is still existing. And on the portfolio management, I think Thorsten gave a wonderful presentation on how we think about it and what we have achieved so far. I think that we're fine on that one. On cost transformation, it's a red. It's quite simple. It is, as Tim yesterday said, it's a half full or half empty class. As roughly by the end of 2018, we will have see an achievement of 50% of the originally proposed 1.8 billion net reduction. For me, the glass is half empty, to be very clear. And the key drivers here have been threefolded. One was, and again mentioned by Tim already yesterday, the IT and our approach to change, especially in the German environment, and partly also Srini mentioned that in the European environment, change IT infrastructure, especially in OSS and BSS with big banks. And it turned out that it's not a good approach. It worked well on the ERP side, but it doesn't work obviously on the BSS and OSS side. And that was a big driver. The second one is the delay we have in the All-IP migration in some parts. You know, we originally guided to finalize the whole thing 2018 in Germany and in Europe. Now we see Greece, Srini, end of 19. We see Germany, the mass market 19, and B2B. So we have a bit of delay in there, and obviously there related to that some more operational costs coming with it during that timeline. But on the infrastructure transformation, that's the reason why we see yellow here. The concept is right, the way we're doing it is right. It's simply we just have underestimated how long it takes and what the efforts are to get, Tim yesterday said, the last percent is the most tricky and difficult one to get the last X percent, single-digit percent off the platform. So we have kind of delay in there. But that's basically where we are, I think, on the middle part, which is related to portfolio and operations. On the debt side, you've heard yesterday and today people being enthusiastic about, and rightfully so, standing here like Mike, talking about, and Neville, about a US nation which had no LTE coverage and now has a fantastic LTE coverage with our network, 40 billion. Plus, because there was also spectrum, and if you sum up CapEx and spectrum. You heard Srini talking about roughly 95% of LTE penetration in Dirk. You heard, and so on. I can keep going, you know? And all those investments have been spot on along the line of our strategy. So it does make sense to do it. But obviously, you need to manage that equation as well. And I remember 3 years ago, I looked into your faces when we said we're going to manage the auction in the US, we're going to invest heavily, and we keep that policy intact. At least 50% of the faces at that time were telling me, you might believe that. We don't. So I think it was important to us, and it will stay important to us, that we have always that investments, that continuous investments to strengthen the future growth profile on one hand, but on the other hand, make sure that we get the green dots here as well. And then on the equity side, on the divvy, I think quite simple, quite easy and straightforward. We delivered on what we've said there, and also on the element of divvy in kind, where We got more and more feedback that very many investors don't like it. And we always said once the incentive auction in the US is over, we're going to stop that instrument, which we have done. So that's basically the framework we laid out 3 years ago and what we delivered. And now the operational KPIs, looking at them, I don't run you through all of them, you know them. The only deviation we had is on CapEx, where we invested more, especially in the German environment. You're all aware about that, and you knew that. Just a word on the bottom right-hand side on the special factors, because it's coming up again and again. That was our guidance, or my guidance, 3 years ago on the special factors on EBITDA, and I will come back to the special factors cash later on as well. And as you see, there is a green dot on it. It simply does mean we are declining. It doesn't mean it's completely going away. It's still high. Don't get me wrong. It's not like I believe that that is a good number. But what we're saying is there will be a continuous decline in that one, and that will keep going. As I said, I'll come back to that in this, later on in my presentation. And obviously, it was not only revenue, but and EBITDA CAGR we've guided and delivered upon, but also, which is as important as the delivery on the CAGR is that you keep investing while you grow. You know, it is relatively easy in our industry to optimize a 1 or 2 year cycles. Sometimes you can even optimize a 4-year cycles on a financial basis. But what you really need to do is make sure that the growth rates are sustainable. You keep the momentum, you keep going, even after, like here, a 4-year period of time. And this is why we put a lot of money in CapEx and investments within our footprint in the US and outside the US, as you can see here, in spectrum, but also in customer growth. Srini mentioned we significantly put money in also for a certain period of time to ramp up again to the minimum fair share we need to have on our net add sides. In transformation anyway, as you know, but also innovation like, for instance, in the US, where we see layer 3 obviously consuming some money to make that successful and happen, or IoT. And ultimately, as I said already, we delivered and you know that the free cash flow guidance and the divvy growth related to that, and outperformed our peer group during that period of time, as you see here on the right-hand side. So ultimately, a lot of ticks in the boxes, 2 of them not, and that's nothing else than a clear marker for us to focus and concentrate more on them where we have failed to get them into a better shape. 2018 to 21, what's up now? Before I go there content-wise, let me spend another minute on why the heck are you talking about 14 to 18? You know, it's history, forget it, it's done, nobody cares anymore. And I can tell you, our view is different for 4 reasons. One is, by doing that reviews, you've seen with my colleagues and here, we remind ourselves and our organization what we have said, where we have delivered against, and where we have failed, and where we have failed, what the reasons have been to learn from that, to make it better next time, to focus more on that. So that is why it is important for us to look at that. The second one is, I think clearly, the message, you can rely on us. Whatever we tell you, it is super important to us to deliver that. Not in every detailed KPI. I tell you now, from the detailed KPI set you have later on in your booklet, which are hundreds and hundreds of KPIs, we will not make them all. But we will make the most important happen, the most important for you guys happen, for our market position, towards the customer and towards the capital markets. And it is important for us to have that kind of detail because there's a continuous external but also internal discipline driven by laying out those details. The third one, which is from my point of view the most important one, is there is, you know, what I said is we haven't built the financial growth of the last 3-4 years at the cost or by burdening the upcoming years. So there is no underspend in spectrum. There is no underspend in CapEx. There is no underspend by creating big backbooks in the organization. That's extremely important. Only if you do that, you can sustain growth rates you have guided for 4 years, for 7 to 8 years. And that's basically what we're doing. We won't change the growth rates on EBITDA, on revenue, on free cash flow. We just keep going like we've guided last 4 years. And you've seen that yesterday already in the overview Tim gave. And obviously one key element here is the free cash flow, which is with the same CAGR guidance driven by 2 elements. A, the US, you heard the guys talking already. And then for the non-US part, for the ex-US part, you see that growth here in as well, driven by A, an EBITDA growth, B, and I'll give you a more detailed view in a minute. B, by, as I said, CapEx peaking this year and a stable perspective looking forward. And obviously C, demographics helping more and more to reduce special factors cash. Still being in the vicinity of $1 billion or so, details coming later, but seeing that declining. So that is the support we see on the DTEGY side. What I'm going to do is spend the next 5-6 slides on DTEGY, because you've seen the US story, I think you're all aware about that. But what I'm trying to do is bring everything with what Dirk said, what Srini, Adele, Claudia, and what Thorsten said in one box, so to say, and I call it DTEGY and make you aware about what's going on there. So first of all, EBITDA. What has happened with EBITDA? I remember well, when last Capital Market Days 2015, the only numbers and figures we had there was 14. And 14 over 13, we had a decline in each and every segment on the EBITDA side. And at that time, people started to think, yeah, maybe the US can turn around. But what we said is we're going to turn around the US, then Germany, then Europe, and then T-Systems will kick in. And basically what you see here is that we guiding a CAGR of 2 to 3% for the DTEGY EBITDA upcoming years. That exactly that order has taken place, by the way, because we've decided also to use CapEx with the same logic and order in terms of focus. Germany was first there. And you see the guidances we put in here per segment we give to make you better understand that this growth pattern on the EBITDA side, DTEGY or DT, is based on a strong US and a strong ex-US business. And if you unpeel the ex-US business, it's not only Germany, it is Europe, it is group development, and it will become next year T-Systems. So there is a broad base of that dynamics taking place, and that's very important for us in terms of our future perspective. And then obviously the magic question about the CapEx. As I said already, CapEx will peak this year, and the outlook we're given here is around the vicinity of what we have seen 2017. So you will not see that, but a continuous path. But clearly this year is peak year. And I don't run you through all the reasons why we ramped it up from 6.3 to 7.9. I think, to be honest, from my point of view, looking in hindsight, I wouldn't do anything different. The only thing we need to do better and be more successful on is the CapEx efficiency, but not the areas we're investing and the way we're investing. So that's basically on the CapEx side. Then if you look at free cash flow, and let us run through, we had the EBITDA, we have now the CapEx. Maybe on the EBITDA, a few more words, because yesterday there were questions already about, on Dirk's presentation, about how does that cost reduction, how that might work out. Let me talk a bit about the cost reduction here. It was mentioned yesterday by Tim, 1.5 billion is the number and the amount we are targeting here of, let me be very clear, net cost reduction. I know there have been questions, is that gross, is that net? As always, it's quite simple, it's net. So obviously, there are headwinds against that. So if you give an example, if we assume 0.5 billion of that 1.5 billion of net OpEx reduction in internal workforce costs, that assumes we need to do gross more, because we will also see wages going up over time. So that's the whole logic, and basically the result of that gross minus headwinds minus the gross reduction offers then that net figures, which is 0.5 on the indirect workforce costs, it's 0.3 on the external, not on the indirect, internal workforce costs, it's 0.3 on the external workforce costs, and it's roughly 50%, like 700 million on the non-headcount related OpEx. I think talking about the headcount-related part, let me clarify a few things. First of all, we feel good about the opportunity to ramp down workload and demand for work, so to say, by digitization kicking in, by simplifying, and I'll come back to that also in a minute. So Srini was talking about it, Dirk was talking about it, Adair was talking about it, and Claudia as well. So there is kind of natural tailwind by that development taking place to helping to ramp down the demand for costs. But the key question I get always, and I understand why, is, okay, let's assume you get your demand for work down. Can you get the people off the payroll or not? And we seriously have concerns that you can't do in the German environment. So what we have done is, and we started that journey some years ago, and Christian was one of the big contributor and driver here, is to early enough get people into schemes, like for instance, partial retirement schemes, early retirement schemes, where for instance, people agree to work for 3 years for less salary. That's what we call the active phase of it. And they have 3 years, they don't work, but they still get the same level of salary. And then they're off the payroll. So we have already 13,000 people where we have personal agreements with. They will leave the company and be off the payroll within that timeline we're talking here, from 18 to 21. And that's secured because there is, so to say, a contract, a written contract, a signed contract between the company and those people. That's number one. Number two is we have about the flexibility of the workforce. Number two is on the external workforce, we have roughly 10K people where we use suppliers to do work for us. For instance, like field technicians or like customer service or other areas. So obviously that is another way of creating flexibility, that once the work goes down, you can also realize that savings on the P&L. So we feel pretty confident and bullish about once the work is done that we get that already realized then in a short term on the P&L side. And then you have the other 50% which is non-headcount related. And just give you on the next page a few examples of what that is. You know, for instance, one example where I'm personally in charge and my role is real estate costs is a 250 million decline next 4 years, which is basically two elements. You reduce the amount of either office space and office floor you use, or on the technology side, remember the chart, I think it was Dirk yesterday showing the chart on BNG migration where you had very many servers and then finally you have one server. It's simply you don't need that space anymore, and then you compress what you need, and then you either stop renting buildings if they're external or you're selling out buildings. So that's one part, and the other one is facility management costs, where we had a change in the supplier last year. So from next year onward, we will see the new supply and the new contract kicking in, and we know what kind of savings will come from that contract. So there is a 250 million ticket where we're pretty much confident that this is I'm bullish that we're going to deliver that. Another one is the shared services. A simple way to look at it is last time I told you for finance, HR, procurement, we're going to, instead of having a shared service per country, we're going to have one shared service for the whole footprint, meaning ex the US. That is what we have established. Our current run rate is 100 to 200 for that old period of time of savings. So we just keep going, and that's what you see here on the efficient shared services. By the way, combined with the ERP platform supporting it, has a standardization level of above 85%. So if you compare that to the standard SAP product, so we are just utilizing what we have established there already, and then you have purchasing costs in various categories. So we feel pretty good about all that non-headcount related stuff that will kick in and support the cost savings. But what we want to do is, as you've seen that charts with a lot of green boxes and the two red ones, one was the costs, we put an extra focus on the whole thing to make sure that we don't miss the boat again. And that is a program we call Fit for Future. Sometimes we call it Fit for Fun. And no, seriously, the approach is every board member is personally involved there. So the whole board is sitting together on a regular basis and discussing what works, what doesn't work, what to change, what happens in their own segments, and how to leverage that in the group and make use of that in the other segment, and so on. So there is a very personal involvement of the top management team in here. And the focus is, and it's very much along the line what Srini said, the focus is not get the costs out in the first instance. The focus is get customer experience up. Because we do know if you do that right, if you get the customer experience up, you get the costs down. Because one of the reasons why we have higher costs is complexity. The way you get your experience up with the customer is simplifying. And believe me, that's one of the reasons why we have that top 3 activities on simplification going on. As Mike said, if you just try to digitize complex environments, you either fail or you fast forward, sorry for the wording, the shit you're producing to the customer faster. So you need to clean up, to simplify first, and that is by focusing on the customer experience. And then you see the costs falling. And that's basically what we're doing here. I don't run through all the levers, as for instance, Srini has done. If you look at the digitization part, there's one part is zero defect service. Srini has talked about the data-driven network rollout, where we de-average the capacity investment. You don't talk about a network anymore. You talk about a prediction per cell, and you put the money at the right place and save CapEx and put it somewhere else where you can have a better return on that one. So we'll very much focus on a simplification of product, processes, organization. That's reflecting what the 3 operational colleagues already told you. And then on the other hand, obviously by customer front-end apps, secondly, service, and thirdly, on the network and the CapEx we're spending there. So now I've talked about the EBITDA, I talked about the CapEx, talked about the costs to support the EBITDA. Let me give you one more outlook, because I know that one concern is, they don't get the people off the payroll if the work is going away. The other one is, okay, they spend tons of money to do the restructuring, and this restructuring cash is going up. As I told you last time, we see a continuous decline in the special factors cash. There might be, like last 3 years, a year where you have a bit more and a bit up, but what you see is on a trajectory of 3 years, you see a decline in that one, and you see on average a decline as well. So it's not the first and last year, but also if you average that over the complete period of time, you see the decline. Why is that? It's quite simple. The mechanism I told you about, the 13K people, we're also using for the period beyond 21. There's a number you see here as well. And B, demographics helps. So, natural attrition is very low on our side, on the German business. Natural attrition will be still in the beginning of the 20s, like 1%, but it will ramp up to 4% just by demographics. So what we are expecting, and that's why we're giving you here also 2025 number, is it will not go away completely, but there will be a continuous tailwind by the development of the special factors on the cash side. And same holds true on the pension cash. There is one very specific element in the whole, if you look at the pension cash outs, which is our civil servants. In case of our civil servants, it's quite simple. That's the gray bar you see on the chart. We have zero volatility on the number because we know how many we have. There are no new ones, and we know exactly when they get into retirement. And the contribution is fixed. So the gray bars have zero volatility. And as you see, the magenta ones, we worked last years a bit to improve that. So there's also tailwind coming from that angle, from the pension cash outs. And finally, to sum it up on the interest and tax. On the interest side, we expect a stable outlook looking forward. And as you see on the group tax rate, there's that big impact which kicked in actually by the end of last year by the US tax reform, which moves down the group tax rate to, as you see here on the chart, from the mid-30s to the 27% level roughly. So as a consequence, you will see our adjusted EPS, which we have guided 3 years ago to being around €1 in 2018. And you see that is exactly what we believe still today, moving up into the around 1.2 euros area in 21. And just as an additional information, we also expect that the unadjusted will exceed €1 by 21. And obviously, what that reflects in terms of growth rate versus the free cash flow growth rates is obviously that the minorities in the US, which are accounting-wise, so to say, in the free cash flow number, ignored as it's not proportionate, but EPS properly reflects that. That's, I think, the big difference. And it was, by the way, also an outcome of listening to you guys. During the course of the last 12 months, there were more and more questions and challenges and concerns about, yeah, you're always looking at the free cash flow, but you don't own it by 100%. It's only proportionate parts you own. So how to look at that? And we decided and we believe that is the right way to look at it because it reflects much better the true economic ownership. And let me then, before I summarize and sum up, talk a bit also about the debt side. I mentioned that also in review a minute ago. We've seen a stable rating from 29 to 2017. And in case of not having a deal in the US, we expect that to keep going. I think the rating agencies have been very clear about what their point of view is if the US deal happens on that one, which is there will be a departure from partly at least by some rating agencies from that rating and also from the comfort zones. But we are super confident. You know, Mike has and Neville, they have shown you this morning why that case is, and it is what it is from my point of view, the integration case. Once we have the approval, we can go. It's a super low risk thing because there is a super experienced team who know how to do it. They've done it already. I don't repeat all that, what was said in the morning. So we are confident that we can come back fast and in case of a deal. But first of all, in case of no deal, we're operating. If you look at the revenue, Tim said yesterday it's about 90% plus in AAA countries. If you look at the revenue side, if you look at EBITDA, it's 85 plus. It doesn't matter. We are operating in a country portfolio profile which is super solid and stable. We still see on the CDS level that the market is reflecting our view that it is important to us and obviously perceived in the same way that we are an anchor of stability on the debt side, and you see the maturity profile being extremely well balanced. Okay, so that's basically as important to us as all the other parts I mentioned, and our job is to get the right balance of all this done. So the new financial strategy is basically more or less the old one because there are no changes on the debt side. There are no changes in the middle part other than the ones we have, what we have evolved in terms of our strategy and where the colleagues talked you through. And the real relevant change is on the divvy side. Again, to reiterate that, we're going to propose 70 cents for 2018 to be paid in 2019. That's the old 2014 to 2018 timeline. We remain the floor we have. We don't change that. We have in our old policy with the 50 cents, and thereafter the divvy growth will reflect the growth in the adjusted EPS. And on buybacks, to be considered, I think Mike mentioned that this morning. Quite simple, you know, in case we don't have a deal, there is, for instance, a buyback program already decided, and we will execute on that one. But I believe that will not take place as the deal will be finally approved. So that's basically for the financial strategy. And before I summarize all that again in that one pager which we're going to use for the financials, let me talk again about, because I mentioned the US share buyback, let me talk about the US and the effects of that amazing opportunity on our side, especially also on the balance sheet. First of all, Mike said it, the synergies are amazing, and the way to get to them is from my point of view, low risk profile because proven team, proven way to do it, etc. And it's only costs. It's only costs. So there is further upside if you look at the revenue part. And that is combined with the 5G leadership. So we have an opportunity here to supercharge the Un-carrier. And I haven't met anyone who was challenging us on that perspective. I never get exactly the stock price reaction, but I never met one challenging those messages. And obviously, as a consequence, you see that for the integration period of time, you have impact on the free cash flow and on the EPS. You see that on the right-hand side. EPS, that's what we're saying, accretive from year 3 onwards. And in the guidance you see later on, what we're saying is year 3 will be slightly dilutive in free cash flow and EPS versus the non-deal case. And it will be obviously an amazing growth opportunity if you look at the right-hand side, the longer-term perspective, be it the free cash flow or be it the EPS. What's important as well is to reiterate that the non-US business is unaffected and it's not affected by that. So it's not like we're cutting down on our original plans we had on the European, on the T-Systems or on the German side. We just keep going like we have planned. And I mentioned that has impact on our financial framework, especially looking at our comfort zone, which we will depart, as you see here, for a short period of time. We are convinced that we will see us coming back. We decided not to change the comfort zone because we want to keep the discipline. We want to move back to that comfort zone rather than just saying, okay, we go 2.5 to 3, deal done. No, we said it's 2 and 2.5, and we go back to that one. And the deal offers the opportunity to go fast and rapidly back to that one. And maybe a few words also on the parental funding. You see it on the right-hand side. Currently, we have in the US a funding by DT of $14.6 billion. We have agreed that at closing, we will see $8 billion to be repaid. And then we have $6.6 billion left. The key message is here, it's not to be renewed at maturities. And the maturities are until 2022, or we can market them. So that's basically how we move then later on from the 6.5 into a 0 number. So we have secured here that we don't overstretch the DT balance sheet on our side. So let me now then summarize all that to the financial outlook for the next 3-4 years. The old CAGR is the new CAGR for revenues. One of my team members said the only reason why you're doing it is you're getting older and older, you can't remember new numbers, you need to stay with the old ones. But I think the way I look at it is, as I said, keep investing to make sure that you don't optimize 2 years, 3 years, 4 years, 5 years, 6 years, but that whenever you stop counting, there's enough substance and enough investments in the company being placed and put to keep the momentum going or even accelerate the momentum. So the old CAGR is the new CAGR on revenue. The old CAGR is the new CAGR on the EBITDA side. The cash CapEx, I said, will be stable for the ex-US part. And the special factors, as you see here on the cash side, will see a decline, still on a reasonably high level, but see a continuous decline, so create a tailwind. And then obviously the free cash flow will grow with that as well. So that's basically the summary for the financials and what we have heard. Normally what we would do now is to, oh no, I forgot the midterm ambition level, sorry, that's important. Tim mentioned that yesterday, but I'd like to reiterate that. The additional information you have here versus what I've already seen on the last chart is obviously the EPS, which will become more and more important, around 120. It is the ex-US CapEx being stable, and it is, again, the divvy policy. And we will use that chart, as you know, continuously to remind everyone what you should expect and what you can expect and what not. For the US deal situation, we confirm everything. There is no change with or without a deal, except the profile you see on the free cash flow, obviously, and the EPS. And as we said here, it will be slightly dilutive and that assumes a positive support by beginning of 19. If that is later on, obviously those timelines might move a bit. But it assumes year 3, slightly dilutive, year 4, already accretive, and then significantly positive growth momentum kicking in versus the standalone case. So that's basically the page we continuously will use. So normally, time now to move to Q&A. What I normally would do is now have Tim here on stage, have Q&A, and answer all your questions. But as very many of you know, I'm going to leave DT by the end of the year. And so I think, and I'm not sure how many of you have that kind of thought in your mind of, oh, yo, this guy can talk a lot, but he will not be here in 3 years anymore. So I think it's, before we have Q&A, it's a very good moment now to ask Christian, my successor, to come on stage, introduce himself, and share a bit of his thoughts on what you have seen during the course of the last 24 hours. Christian.